Hi, and welcome to this week's podcast. I'm here with Shawn DiMartile. He is the co-founder of Takeoff Capital and co-host of the Real Estate Takeoff podcast. Shawn, thank you for joining me.
Daniel, thanks so much for having me on the show. I'm excited.
My pleasure. I'm actually really looking forward to this conversation. You have a very, very unique, I should say, spin on how you got into the real estate game because you did everything you were told not to do in best practices, which is start off by liquidating your 401k. So tell us a little bit about what decided for you to go a little crazy and sell off your 401k and start a huge investment with the 32 units you started out with.
Yeah, so a great question. So to provide some context, I was working as an air traffic controller, which is stressful and a lot of hours. I was working 6-day work weeks, and I was maxing out my 401k the whole time I was an air traffic controller. And I was, subscribing to the traditional dogma of, max out your 401k, work your career. When you're 59 and a half, you can start, you can officially retire at that point and start withdrawing if you'd like, all that kind of stuff. But I didn't want to stay in that career for my entire adult livelihood anymore.
Mhm.
I didn't want to stay until retirement. It stopped making sense to me. And while I do understand the tax advantages to 401ks and why they can be so helpful for people, my focus was different because I wanted to reach financial freedom before I got to retirement age. I started to realize that if I invested heavily into real estate, I could achieve cash flow that could help me quit my job. And that became my number one focus. So for me, in order to do that, one of the things I could do was to withdraw from my 401k and go all in on real estate investing. Now, understanding fully that that was a huge risk, because what if the real estate investing didn't shake
Yeah.
out and I lost
Yep.
that 401k?
Yep.
But I did withdraw during COVID when they removed the penalties for withdrawing. So I did utilize that to avoid having to pay the 10% penalty, and I was able to pay the taxes over the course of 3 years instead. But that was really just the reason why I did not want to wait until retirement to access that money. I wanted cash flow, and it worked out because I was able to quit my job 2 years later.
I mean, it worked out, and I mean, one of the scary parts is, well, you're making your first investment with a 32 unit property, right? I mean, did you have any fears about doing that? And I mean, I guess the question is, what gave you the guts to be able to go in that big on your first investment?
I was definitely scared. I was worried about things not going right. But I thought about it a couple ways. I thought, number one, if I do make mistakes here, if this doesn't work out, I still have my job. That's a high income job. And even if I had to restart, I personally was going to be okay with that,
Mhm.
because I was gonna be tenacious and keep trying to invest in real estate regardless. I knew that that was a path to wealth and passive income. Now, but in addition to that, I had partners with me. That was a joint venture deal, a JV deal. So we had one partner that had already owned multiple apartment complex, so that helped us reduce risk since we had some experience. But I also had, there was 5 people that invested in that deal with me, so I knew it wasn't just me alone, which definitely made me less fearful.
Yeah. So, did this partner of yours have experience when you started?
So one of them had experience and had several hundred apartment units, and
Okay.
he invested alongside us and brought some experience in, and definitely
Good.
had the net worth requirements to help us get a loan. And then that was the extent of it. The rest of the guys, we had some experience, with single families and things like that. But we had been studying multifamily and doing everything we could to learn as much as we could about it. But we did not have a lot of experience on the team other than that one individual.
And now look at you managing $50 million in assets and over 300 units. So that's obviously extremely impressive. So what were some of the business strategies? I mean, I'm sure you don't go from 32 units to 300 units although you did it in a couple of years, right? I mean, you started in COVID and it's been maybe 2.5 years at this point now that you've been in this industry. Uh, what were some of the I guess the business structure that you put into play that allowed you to grow so quickly in such a short period of time?
So the main thing that I would attribute a lot of my success to is, number one, I got a mentor. So after that 32 unit, you know, Well, let me take a step back. Me and my business partners went all in on this in the sense that we did everything we could to start expanding our reach. So we started a podcast. I started writing a blog. We started on real estate meetup. I started going to real estate events and other real estate meetups, doing everything that I could to learn. Because even the podcast, like we were bringing on multifamily syndicators so we can learn from them and ask them the questions we want to ask. But surrounding myself with successful people was huge. And by far the ultimate pillar to that was getting a mentor who has owned over 8,000 apartment units, that helped me get my 2 syndications after that deal. So that was huge because like when you have a mentor, you're skipping forward like 5 steps, and that's going to help you avoid huge mistakes. It's going to help you avoid or help you attract more capital since you have an enormous amount of experience on the team at that point. So those are some of the big things. And then outside of that, it was really starting to set up systems to attract and nurture investors. And there's a lot that goes into that, because to do this business, you have to be able to raise millions of dollars on a consistent basis. So there was a lot of work behind the scenes that goes into that too.
Yeah, and so you mentioned the two syndications that you came. One of them was for 150 units. How did you come across that? What position did you put yourself in to be able to actually do something like that?
That was mostly due to my mentor. So the position I put myself in was I actually invited my mentor on my podcast as a guest. And after the show, we're talking about how we were looking for a mentor, et cetera. So that plays a huge part in this because he actually owned this deal for a number. He had owned it for 6 years. And the deal still had a lot of meat left on the bone. It just needed to be recapitalized to go do more renovations and continue holding it. So we brought in our investors to purchase the deal from him and his investors. And then he also co-GP'd on the new acquisition with us. And that deal has been killing it. That's actually the best deal I've done to date, essentially. So we got actually the two big syndications we did were done in a similar fashion.
Interesting. So, are you an advocate of learning a territory before investing? Because you started out in Annapolis, and obviously one of your best, now you say your best deals in Greensboro, North Carolina. How much research are you putting into these before you're pulling the trigger on that? And if what are you researching?
I am a huge data geek, so I do a ton of research because I believe that that's the best way you can mitigate risk. Because there's always risk, but you got to mitigate it and then basically set yourself up with the highest probability of as possible for success. So a lot of what I look at, like here's just some metrics I like to look at off the cuff. I like to look at things like median household income. That's extremely important because tenants usually have to make 2.5 times to 3 times the monthly rent and gross income each month in order to qualify for the unit. So the higher, if you plan on renovating and increasing rents on those renovated units, you got to know that a lot of the renter population can afford those rents. So I love to look at that. And I also like to look at metrics like crime, school quality. Those kind of simple stuff are going to get you higher quality tenants and usually higher income earning tenants because those are going to be more sought after neighborhoods. So I love looking at stuff like that. I like looking at the jobs that are available to tenants. I like to make sure there's a good assortment of jobs. For example, I wouldn't invest in a market that heavily depended on just a military base or that heavily depended on one type of manufacturing base. You could look at examples like Detroit when a lot of the car manufacturing went south, what happens to a city. Military bases aren't there forever and sometimes they close down. So I look for things like that. I look for population trends. The list goes on and on as far as the data I look at. I look at the percentage of renters. Like I like investing in markets where there's more renters than there are homeowners, because that's a bigger pool for me to pick from for my renters. So lots and lots of things like that as far as neighborhood and market demographics play into whether or not I feel the investment has a good chance of success.
So, I mean, is this things that you've learned through experience, or is this where when you got a mentor, these were the things that they said, hey, go after this kind of information, look at this data, and be able to understand these trends?
A kind of both. I did a lot of independent research before I even got into like that first 32 unit and liquidated my
Right.
401k. I was doing things like reading every book that I could possibly find on multifamily investing, absorbing tons of free information from podcasts and the internet, like just learning everything I could without having to spend an exorbitant amount of money to learn it. And a lot of those things I did learn from doing that, that period of being a student of multifamily real estate, of this apartment investing strategy. And yes, whenever I acquired that mentor, that just took it to a whole nother level,
I love it.
because
Yeah.
he was able to really show me how these metrics matter in real time and how it determines how he's managing his property, how he's selecting his markets. All of that stuff is so vitally important, because it's one thing to find a property that looks like you're buying it at a good price, but if you really want to maximize the returns, those kind of demographics and data points are really what's going to guide you. The best real estate investors, like for example, some of the best real estate investors I know, when they're selecting markets, they're looking at even things as minute as where, like U-Haul trucks and moving trucks, where are they, the most of them going from and to. So for example, if there's a huge amount of moving trucks that are being rented and used from New York and they're being dropped off in Florida, then that's one of the ways that you're able to determine that a ton of people are starting to move to a certain market. So there's like a lot of strategies
Interesting.
that these investors will use to say, hey, this place is growing, a ton of people are moving here, it's got great schools, the crime is low, families want to live here. And when you see that, you can also look at supply and demand. Like here in San Diego, for example, I'm investing heavily in San Diego right now because there's a
Right.
massive supply and demand imbalance. And I think that that's one of the strongest economic drivers. So I like to take advantage of that.
Interesting. So the example that you gave, which is extremely creative, I've never heard of that. But I invest a lot into the market, and one of the strategies that I don't remember who it was off the top of my head, was looking to see if he wanted to invest in oil or not. And what he did is he sent a drone to above the largest oil refinery in the country to see whether the oil levels were lower or higher based on where the head of the foundation was. And as oils were dropping down, he realized, okay, the demand is going to skyrocket because they're going to have to come in, and that's when he knew whether to buy in or sell out, was based on how much the roof of the oil refinery was. So there are a lot of creative ways, and data is, like you said, data is king, and a lot of people make decisions, good decisions and bad decisions, off the right data or the wrong data. Shawn, I always have to ask every investor that I talk to, especially in real estate, your first deal. I always say your first deal is probably the deal you're going to learn from the most. And that's going to be the deal whether you either decide, hey, I'm in, or forget this, I don't ever want to have to do this ever again, right? Was there any learning lessons that you learned from your first deal? And if so, how does that translated?
Oh my goodness. I'll start rattling them off because I made a lot of mistakes and learned a lot of things. So you could stop me when I'm talking too much. But one of the biggest things I learned, I'll tell you, is when you're doing projects like this, your due diligence phase needs to be really thorough. What do I mean by that? Let me first tell you the mistake I made. When we got that 32 unit, we did pay for a commercial property inspection.
Mhm.
But I would, going back, I would have made it more thorough, because what ended up happening is they look at things like the roof and the air conditioning systems, all the major components. But I didn't really understand how good of shape the air conditioners were in, the HVACs. So what ended up happening is the first summer, because we bought that property in the winter in December, and as summer rolled around, air conditioners were dropping like flies. I'm talking, we averaged about like 1 to 2 air conditioners per month that were completely unusable and had died, and we had to buy brand new ones. And we didn't really account for that in our underwriting. So, we had upwards of, 20, $30,000 in air conditioners that we had to replace. So now whenever I do my inspections, I say, I want you to look at every single HVAC, and I want you to give me, how old it is and what the estimated useful life is. And a lot of times they're going to charge you extra for that. I even created a spreadsheet and said, like, here, you could use this if you want, but I need to know. Because if you just buy it and they're like, yeah, it's working, and then you run into my position and you don't have $20,000 to replace those, you're going to have problems. Another thing that happened was we didn't have every single one of these sewer drains scoped with a camera. And during the business plan, this building had old clay pipes for some of the sewer drains and a lot of cast iron pipes. Well, one of those clay pipes had collapsed completely and was blocked and was causing backage in some of the units. Now, what I do is every single sewer line that can be scoped, I want it scoped. I want to know the condition of it. You are going to have to pay money for this extra with your inspection, but you've got to know, because these older properties, especially if you're buying something that was built in the 60s, 70s, maybe even earlier, the plumbing is a huge expense. I mean, those old properties leak like an old wooden ship that you're just constantly plugging holes. And so now I want to know, what kind of piping is it cast iron piping? Okay. What's the condition of it? Because those will corrode, and the pipe might be, an inch and a half or an inch. And over time it's squeezed down to a 1/4 inch. And that's what all the water and junk is trying to get through. So I look at all that kind of stuff. So due diligence is a huge one. And now I'm also make all of my deals much more well capitalized, because we ran really low on cash and actually had to borrow more money to complete the business plan. Now, it was a successful business plan. We tripled our money. It was awesome. But now I always make sure that I have 20% minimum in contingency capital on top of the renovations that we're anticipating. Because I'm telling you, especially if you're buying an older asset, things will go wrong. I promise you. There's going to be expenses you weren't expecting, because you can do the most thorough inspection on planet Earth, but it's not like they can just remove all the drywall and look behind everything and inspect all that stuff. There's only so much they can look at. So that's another big one. And, let me try to think of one more. Like, I did learn, I did hire some bad contractors. So I definitely have a really strict criteria and a whole process I go with trying to pick good contractors. I'm sure there's people that listening to this right now that can raise their hand that they've been screwed by contractors before. So, I learned lessons there, but I think at the end of the day, if you're going to be a real estate investor, I don't think it's possible to not make mistakes. I don't think it's possible to have everything go completely right on a business plan. So that was a huge learning lesson to make sure that I'm prepared for stuff like that.
Some sound advice. A lot of our listeners are real estate professionals. A lot of them are agents who are looking to get into the investing game. If you think about it, the perfect the perfect storm is you become a real estate agent, new agent, buyer's agent, eventually become seller's agent, grow a team, start doing some real estate investing, and ultimately become a full-time real estate investor. Do you have any tips and tricks from your experience? Because I know you come from a different avenue. You come from a very unique perspective than most real estate investors. So if I were a real estate agent looking to get into the game, or I was a new entrepreneur looking to get into the game, what might be some golden rules that I would use to start for my first deal?
Golden rules for your first deal is, I think number one, something I mentioned just a little bit ago, is you need more. Just make sure you're bringing to the table more money than you think you need, because one of the main things that can happen to new investors is that they run out of cash on a deal, and then they end up having to sell the deal just to get out of it. You don't want to be that person that runs out of money. You need more than you think. Number two, never, ever, ever have a business plan where you tell yourself, all right, we can come up with this much money. The rest of it, we're going to use cash flow from the property to fund renovations. That's a recipe for failure. I've made that mistake before. If you're depending on future cash flow to fund a business plan or to fund renovations, you're taking on a lot more risk, because if things start to happen, if you don't, you start running low on cash, or you're not achieving the rent you thought, or you get like high vacancy, all kinds of different things could happen to put yourself in a position where that cash flow you were expecting wasn't there. So I would say never, ever do that. And then the third thing I would mention is to try to get a relationship with somebody. It doesn't necessarily have to be a mentor relationship. but somebody who's highly successful in the strategy you want to use, you need to find one of these people and build this relationship. Now, in my opinion, one of the easiest ways to do that is to either start your own real estate meetup in your city, or go to other real estate meetups. And that's where a great place where you can find highly successful real estate investors. And if you want to start to build a relationship with them, and in my opinion, provide as much value to them as you can. One of the ways that I always recommend people do that is, once you've established a relationship, tell that person, hey, is there any pain points in your business that you need help with? I will do that for you for absolutely free if you show me how it's done. And you're providing them some free labor, but in exchange, they're teaching you how they run an important part of their business. And you're going to learn from an expert that's been doing it for a while. And that is just a huge piece of advice that I would give, because you'll avoid mistakes that way.
I love that last piece of advice. I don't give this info out too often, but when I first started at Set Schedule, I was actually studying biology, or at that time, I guess I was studying engineering, computer software. And when I first hooked up with my CEO and COO, Roy and Udi, I was interning with them for about 6 months, where I was scheduling appointments for them to go out and make the sales. And that's what led me to be the first inside sales rep management, and grow my way up. So I think that piece of advice is, that is golden and so underutilized by a lot of younger entrepreneurs, or younger kids who want to get into the entrepreneurship. Providing a free value to someone, they won't say no, regardless of how large they are. They could be the biggest, and they'll always be willing to hear you out, at least, because that's who they're looking for, right? They're looking for the people who are willing to invest their time, and know how valuable their time is. So, awesome. You have a book, California Gold, and I really love this topic, because when you talked about finding a mentor in the strategy you want to work in, you did exactly that. I mean, your book, California Gold, is basically a unique perspective on using tactics, specifically in San Diego, that you found that is kind of what solidified you and brought you into the game. So tell us a little bit about your unique tactic that you used in San Diego.
Thank you so much for asking. I really appreciate that, and appreciate the plug on the ebook, which is 100% free, by the way. So, just to provide a little bit of quick context here, so people understand what the book is about. Some of your listeners may have heard of accessory dwelling units, otherwise known as ADUs. Those are really popular here in California. Basically, what that means is you can take a single family home and even a multifamily property, and in the state of California, you can add units to it, apartment units, and they call those apartment units ADUs, accessory dwelling units, because it's a new municipal code that they created. But they work and operate just like any other apartment unit. They could be up to 1,200 square feet. So you could take a single family home that you bought that's got some land in the back. You can put 2 units back there and have yourself a triplex that's cash flowing. You can usually build those units for much cheaper than what you would buy them for existing on the market. Now, what's unique to San Diego, and why I wrote my book, is San Diego is geographically constrained when it comes to building new housing. They have the Pacific Ocean to the west, Mexico to the south, mountainous terrain to the east that's really expensive to build on, and the Camp Pendleton military base to the north. And San Diego has been a growing city. It's basically ground zero for the housing crisis, because the median home price is just shy of $1 million here. And the reason is there's just a low supply, really high demand, and there's nowhere left to build new housing. There's no more flat buildable land that developers can build on. So San Diego took that ADU state law, and they expounded upon it to where you can build an unlimited number of ADUs on your property, up to the floor area ratio for that zoning. So what this means is you could take a single family home that's sitting on a decent sized lot, and you could build 5, 10, I've even seen 20, 30 units built on it if it's a big enough lot. And we're literally talking like putting a 3-story apartment behind the house. And the city did this because of its unique issue, because they need to build 108,000 new housing units by 2029, according to their 2021 annual report on housing. But they've only been averaging a little over 5,000 new housing units each year. So they need to triple the amount of new housing units to meet housing demands here in San Diego. So My ebook, California Gold, I call it that because I'm calling it the new California Gold Rush, because this is a extremely profitable strategy, but there's only so many lots in San Diego that make sense to do this strategy.
Mm-hmm.
In other words, there's only so many houses that have a big enough backyard to go and build enough units to make a bunch of money. And so I call it the California Gold Rush because like a prospector looking for gold, as an investor, we're out there panning for gold by looking for properties that sellers are willing to sell us that have a big enough lot to do this business plan.
Awesome. That's super unique. And when I first heard that, I was actually blown away. And I guess the organically the next question comes is, how did you even come across this strategy?
So this strategy is brand new. It's only 2 years old. San Diego implemented it 2 years ago. I came across this strategy from some real estate developers and investors that I met at my local real estate meetup I was hosting.
There you go.
And
Real estate
yeah, so
meetup.
again, more value from meetups. And I met these guys that were like really crushing it. And when they were showing me the numbers, when they were showing me what they were building, it all made so much sense to me. And I'll give you 3 reasons why it makes sense and what got me to just the light bulb went off. Number one is the reduced risk that having an existing property gives you, because with traditional development, you're buying an empty lot, then you're spending all this money on architecture, designing, permitting, and stuff like that to try and get permits from the city. And while you're waiting for years, you're not making any income, so you're burning through money. With this strategy, there's an existing house there, so I can actually rent it out to cover the debt. And in the case of one of our projects, for example, we got an Airbnb permit from the city, so we're actually cash flowing while we wait for permits. So you're reducing or completely eliminating holding costs for one. Two, here in San Diego, if you're going to buy a value add apartment complex that's already built, you're going to spend anywhere from $450,000 to $600,000 per door to buy that property. And then, since the landlord tenant laws are skewed so much towards the tenant, it's very difficult to say in this state to say, I don't want to renew your lease because I'm going to renovate this unit. You have to move out at the end of your lease. The state protects tenants from that. That's not a good enough reason for them usually. There's all these other caveats you have to check off the box. In this case, I'm building the units brand new for $150,000 to $200,000 per unit to make some pretty nice ones. And I get to fill the tenant that I want at market rate from day one. So it's easier for me to kind of predict. And then the third reason is because I'm able to buy properties in the most coveted neighborhoods in San Diego and add units to them, where otherwise there is zero flat buildable land for me to go build new units. So for example, I have a project right now a half mile from the beach, and I'm building 11 additional units on it. And those are going to be brand new units in a beach community that otherwise has 0 brand new units. So those are 3 reasons that I really love about it. And I essentially just stumbled across it from learning from people that heard about the municipal code and started crushing it.
That's awesome. The power of working in groups is really, especially in the investment space. I mean, you can make so many mistakes, but if you can learn from those who've made the mistakes or know the rules, you can only be, and the way I see it is, you can only be excellent in so much. And utilizing other people who are awesome at and understand the rules like that is pretty impressive. You talked about diversification. You're fairly diversified yourself when it comes to the real estate space. Not only do you have the multifamily units, but you also have hotels and Airbnbs. Is there some logic behind how you came across these, or was it just, I found a great deal and I just went after it?
So, for one, I like to keep my horizon open to be able to jump on opportunities when I see them. And Airbnbs, the boutique hotel, I saw enormous opportunity in those markets that I bought those in. But when it comes to like the short-term rental stuff, the boutique hotel, the diversification gives me more cash flow that way, because like those kind of business plans have pros and cons, right? Airbnb, short-term rental stuff, you're going to get a lot more cash flow, which I can use to supplement my income and live off of. But there's not as much of a pop when I go to sell it years down the road compared to commercial real estate. Commercial real estate is almost the opposite. Like you can have some pretty decent cash flow. It won't be anything close to, the short-term rentals, But you do get a lot more appreciation and value add potential to where when you sell it 3 to 5 years down the road, you get a big fat check. So I wanted to be able to have the best of both worlds. The short-term rental stuff is in my portfolio because that's what I really use to live off of and pay my bills. And then syndicating these larger properties is my long-term strategy. That's what I'm using for the long-term wealth gain, increasing the net worth substantially, et cetera. So I like having that mix in my portfolio for that reason.
So you've talked about syndicating deals, and this is something that comes up because I mean, obviously everybody wants to get into that game. That's where the real money is in, right? Is there is there kind of like a natural progression into becoming a syndicate? I mean, do you have to have X amount of dollars or have X amount of money coming in? When do you know that you're ready to start to fund other people's deals rather than just your own deals?
That comes from two things. Number one, I think that if you want to start syndicating properties and elevate to that, I think it's just imperative that you partner with another operator that has experience doing that because it gets very complicated. There's a lot of legal stuff involved, and I couldn't imagine doing that without having an experienced operator holding my hand through the process for a couple deals. In addition to that, it's going to be a lot harder to start raising money because we're talking about syndicating. We're talking about raising money from friends, family, and strangers, millions of dollars usually, in order to do these big deals. And in order for people to want to invest with you, I'm telling you right now, they need to know, like, and trust you and the team. So I think the number one thing is having a good relationship with somebody that's already doing that so you can get your feet wet. Number two, to know that you're like ready to start doing that, you've got to feel pretty comfortable that you can raise a couple $100,000, that you can carry your weight and actually add some value to the person you're going to be syndicating with. If you're going to have a cut of that equity. And to do that, I'll be honest, it's hard. It's a lot of work. And the reason why is because if you're going to start raising millions of dollars and do multiple deals, so millions of dollars continuously, you've got to have a big network of investors. And the only way to do that, unless you just are a wealthy person with a big network, is to put yourself out there and cast a wide net. And I mean, do everything, whether that's your own platform that's a podcast, YouTube channel, putting stuff out on Instagram, writing blogs and sharing that so that your listeners and viewers can see that you actually know your stuff. Because otherwise, if you were like me and you're an air traffic controller, and you say, hey guys, you want to invest $50,000 in this deal? They're going to say, hey, you're an air traffic controller. Why would I trust you with my hard-earned money? So you have to be able to demonstrate to these people that you actually do know your stuff. And you need to do that by going on podcasts, writing blogs, writing stuff on LinkedIn, going to meetups, speaking at meetups. Like, I do all of this stuff because from all of those things, I get some investors, and it also builds your credibility. All of that stuff plays into it. So if you want to do it, look at people that are highly successful doing syndications and replicate everything they did. Did they write a book? Did they write an ebook? Do they have a podcast? If you're answering yes to those questions and you're not doing any of those things, and then you're saying to yourself, well, I can't raise money. Well, don't complain about it unless you've tried all of those things.
I think the common misunderstanding of this is people think, well, if other people see me doing it and I'm successful at it, they'll naturally want to come and say, hey, let me give you your money. And that's not how it works, right? I mean, it's just like in the real estate game. You know, you've got real estate agents that expect just because they talk to their mom's friends that all of a sudden everybody's going to come out and say, hey, I know you're an agent, let me sign with you, right? That's not the reality of how the entrepreneurship game works, especially at that level. I mean, you've got to be going after it and you've got to be marketing it. And I really appreciate you being blunt with what it takes to be successful at that, because there's definitely a misconception of how much marketing and resources. And by marketing, I don't mean resources. I don't mean dollars, spending the dollars, like you said, right? It doesn't cost you to do podcasts. It doesn't cost you to write an ebook. Heck, you're giving away your ebook for free and you spent your time on it, right? So I really hope people take that to heart.
That's about it. Like, I'll put it this way. I spend the majority of my time doing all of these things to raise capital. That's what I spend the most of my time doing. You have to learn marketing. You have to learn sales. You have to learn marketing funnels. You have to learn what it is that psychologically attracts people to investments. It's a ton of work.
Great games. Yeah. I would be failing our listeners if we don't spend a little bit of time talking about tech. And I know there's so much more that we could talk about, but I do want to shift a little bit, if it's okay with you, Shawn, talking a little bit about tech, especially because, again, I mean, with how large you are and with how many assets you're managing, you've got to be using something to make your life easier, because I'm sure you're not using spreadsheets or Google Docs or anything like that. So can you talk to us a little bit about the tech that you've kind of come across and what you feel has been working for you best?
Absolutely. So, since we were just talking about marketing, one of the top things I would recommend that I use is called Active Campaign. This is an email
Yep.
marketing
Yep.
tool that's extremely powerful.
Hmm.
And for those that aren't familiar with stuff like that, it's more than just sending emails to a large list of people. It's so much more than that. It's how it ties into your landing pages and funnels. It's your email sequence. When you have a deal and you send an email, what does that look like? When somebody comes and signs up on your website and fills out the Invest with Me form, what email are they going to get the next day or immediately after? How are you going to keep that lead warm? What kind of value are you going to keep giving them to make them open your emails and see? There's all kinds of stuff that goes into that. And Active Campaign is the most powerful tech tool I use for that. I really like using a tech tool called Notion. The reason why is because I have virtual assistants and there's a lot of minute tasks that get assigned to them and that I want to make sure are tracked. Because when you're like onboarding a VA and you have all these different things they're doing for your podcast, your newsletter, and stuff like that, they can't forget anything. So I like to use Notion because I can set tasks for them and track, like, they have to click when they've started it, when they finished it. It sends them an email when that task is supposed to be started. It sends them reminders. There's all kinds of things I could do with that so I can keep people on task and not forgetting things. Another very powerful one that I love to use is called Miro, Miro. Now, this is basically a systems creator. So I can create these flowcharts of my acquisition process, for example,
Your
in very high
SOPs.
detail so that you're visually seeing it. But in addition to that, on each of the nodes I create for each step in the process, I can include a checklist that's attached to it, links, things like that, so that if I have an acquisition specialist, for example, and we get a property identified, they can go through that flow chart and then click each thing, and there's a checklist there so that they don't forget everything. They know the deadlines. They know when they're supposed to do stuff. Just, when you're syndicating and doing these kind of deals, it gets very complicated. So you have to have systems and processes. And one great example that I read from the book The E-Myth, which is a great book on entrepreneurship, is breaking things down like you're a McDonald's franchise. You need to break it down to the lowest skill level you possibly can and make it repeatable. So that, like I said, with that acquisition process, every single step along the way is on there so that you can't make a mistake unless you literally don't look at that process. So, that's just a couple points of my tech stack. I could probably keep going on and on, but there's so many tech things that I use in my business that have helped me optimize it over time.
Thank you. I sincerely mean that. We obviously at Set Schedule, we are a technology company, and we, business development for real estate professionals. And the one thing we talk about is how important it is to have technology to basically manage your day for you, right? And not have these, I'll figure it out kind of concepts, and having your standard operating practices and putting them in writing, and making sure that it's stuck to. And the fact that, you come and mirror that idea, especially with the email cadences. One thing we really preach is having automation do the work for you. And a lot of entrepreneurs and business owners, they don't have those set up, right? They get a form and they're hoping, all right, I'll call them once, and I'll call them once and they'll answer. If they don't answer, I'll leave a voicemail and they'll call me back, right? No, that's not how it works. So that and having and I love the example, you be a McDonald's franchise. I mean, that's awesome. So how early on in your career did you start to put this tech together? Is it something that you realize, oh shit, I got to put this together now? Or is it something that someone had, one of your mentors had say, hey, start off, have this, and don't fall behind?
About a year ago, actually. It was later on in my business. And I'll tell you, and it was one of my mentors. And I want to throw this out there too. I have multiple mentors. I have my apartment mentor that I alluded to earlier in the show. I have a mentor that's essentially a capital raising mentor, and I have a business coach. And about a year ago is when a lot of these systems started to get implemented. And I'll tell you what, it really, the earlier you do it, I wish I would have done it earlier because it reduces stress. Because if everything is just in your head or on a Google Doc, you're going to keep thinking to yourself, all these things are swirling around in your brain. Oh, I don't want to forget to make sure I scheduled this. Oh yeah, that's right. I was supposed to send this out. Oh man, I need to come up with some newsletter information. If you have a bunch of systems in place and you have it, on your calendar, very detailed when certain things are going to happen and reminders set, you can let yourself forget about it and just move forward with the process so that there's just way less stress. I realized it was like a huge weight off of my shoulders the more processes I put in place.
Yeah. Yeah. Well, I hope people start to adopt technology. I mean, CRM is where we always push. Start with the CRM system. And if it has, more features for automations and sending out emails and all that, it's always a good little boost. Shawn, we're coming towards the end of the podcast, and I always like to leave it off with asking if there's any advice that you have for someone who's looking to get into either the entrepreneurial game in general or specifically into the real estate industry. What advice can you give them outside of all the awesome piece of information you've already given us today?
I want to say this loud and clear. You start with all the free stuff, guys. Number one, there's a ton of free information out there on the internet, be it podcasts like this one, be it blogs, be it books that you could read. You need to become a student. If you really want to become good at this, think of it like you're an athlete. Athletes that want to become the best, they're practicing all the time. When other people are out, having drinks, going to music festivals, doing all this stuff, they're at home being a student. They're practicing, they're putting the reps in. This is to be a really successful, you're going to have to put a lot of time in this. So you need to get that in your head and you need to really dedicate yourself to it. So I think that that's one of the biggest pieces of advice I could give. The second one that I want to throw out there too is be okay making mistakes. Don't let that hold you back. Don't be so afraid of making a mistake that you never take action, because eventually you're going to have to pull the trigger. And guess what? All entrepreneurs make mistakes. So I think those are the two things I want to get out there. I think a lot of the other stuff we've talked about are great points and stuff too that they could take home. But I think most entrepreneurs need to get that in their head.
Amazing. If someone was looking to get in touch with you, and I know we're going to put all the social links in all the channels of your channels, what's the best way for someone to connect with you?
I want to give two ways. Number one, follow me on Instagram, because I put a lot of work into that. And as soon as you check it out, you'll see that every single day I'm putting out content showing how I do my stuff, giving away my secrets, and telling my story. So it's simple. It's my first name _ last name. So for Shawn _ DiMartile on Instagram. My name is going to be on this podcast, so you'll find me easy. And then you can also go to investorshawn.com, which is spelled SHAWN. And that's my personal website where you can access everything from there too.
Awesome. Well, Shawn, really, thank you so much. The amount of information you provided today was amazing. I mean, I've personally taken a couple of good notes myself. So thank you for your time. We really appreciate it. And hopefully we'll be in touch and we'll see you, instead of 50 million, you'll be at 500 million in the next couple of years. So that's the track record you're going to.
Thank you so much, by the way, for the opportunity to come on your podcast. I don't take it for granted. I love these opportunities and be able to provide as much value as I can. So I hope the listeners enjoy it.
Oh, I'm sure they will. Guys, and thank you so much. We'll catch you on the next one.